As you remember from the last video, call options give the buyer the right, but not an obligation, to buy 100 shares of a company's stock or ETF per contract from the option seller within a specific period and at a given strike price. And in exchange, the call option buyer will pay a premium to secure that contract. In other words, the person who sells the call option may be required to sell stocks to you, the option buyer, at a specific price known as the strike price, should you decide, at any point before the expiration. And in exchange for that, you pay the option seller a premium to secure the contract. Let's take this example with coffee beans. It's just for fun because we really aren't trading coffee beans, but stick with me. Let's say we have Jimmy, Sally, and coffee beans. And today, coffee beans sell for $10 a pound. Now, Sally thinks the price of coffee beans will likely go up in the next month. So, Sally enters into a contract with Jimmy to potentially buy 100 pounds of his coffee beans sometime within the next month for $10 a pound. And in return, they negotiate a premium of $1 a pound for the option. So, Sally gives Jimmy $100 because, remember, the contract is for 100 pounds of coffee. And this $100 is the option premium, and the contract is a call option. Fast forward next month, and we have 3 possibilities. Scenario 1, coffee beans now cost $14 a pound. Well, what do you think Sally's going to do now? For sure, Sally's going to exercise the option and buy beans from Jimmy for $10 a pound because that's the strike price and it's the terms of the call option. Scenario 2. Coffee beans now cost $10. If this is the case, Sally can choose to buy beans from Jimmy if she wants, but there's no real reason. She could buy them from anyone. Scenario 3. Coffee beans now cost $9 a pound. Well, in this case, Sally will surely not buy beans for $10 a pound from Jimmy. So what happens? Well, the option expires worthless. Now, let's look at some real-world examples of call options and how they work. Remember, people who buy call options believe that the stock is going to go up above the strike price on or before expiration. And let's take this real-world example of Apple. In this example, Apple is trading at $168.82. A call option buyer would expect the stock to go up and trade above the strike price by expiration. In other words, they're bullish on the stock. So let's say you think that Apple is going up. You could buy a call option at a slightly higher strike price, say $170, that expires in 3 months. Now, at any point between today and expiration, you can choose to exercise the option and buy 100 shares of Apple from the call option seller at $170 a share. And of course, you're only going to do this if Apple trades above $170. And in exchange, the option seller will require you to pay a premium. So what's in it for you? Well, let's say at expiration, Apple is now trading at $185 a share. And remember, your call option has a strike price of $170. That means you can buy 100 shares of Apple for $170 each. And then you can keep them or resell them for $185, and then you make $15 a share in profit. But what you do with the shares is up to you. Now, if at expiration, Apple is trading below the $170 strike price, well, the option expires worthless. And the only thing that you lose is the premium you paid for the option.